The new Samvat 2081 will see the most number of investors in India who are sub 40 years of age, ones who haven't seen a bear market and ones who probably need the best advice from Diwali masters. And that is what both me and Samina intend to do on today's show when we speak to two market veterans and talk to them about how do they feel about the new Samvat. The gentlemen need no introduction. Mr. Raamdeo Agrawal, Mr. Manish Chokhani. Gentlemen, both of you, thank you so much for taking the time out and being with us. And at the onset of this show, wishing you and yours a very happy Diwali and a prosperous new year. Thank you so much for being with us today. Manish, you want to kickstart the thing, because I understand that as is the norm, all of us should compliment and pay a tribute to the veteran Raamdeo Agrawal in this special occasion.
Absolutely. Thank you for giving me the chance, because I haven't met him since they made that wonderful donation to the IIT Bombay from the Motilal Oswal Trust, 150 crores to further the cause of investing with some of the best brains of India. And I remember writing an article for Economic Times in 2007 or 8 that this is the real path of capital markets taking you to nirvana. And in the tradition, how Rakesh Jhunjhunwala had given a lot of money for philanthropy, our own Nimisha has built out Flame University, and Raamdev ji and Motilal ji, what they're doing, truly something to feel inspired and grateful for. So I just want to give him my heartiest congratulations and best regards.
Mr. Agrawal, you want to respond to that?
Yeah, in the sense that, I mean, we made money very recently, so, kind of, we are starting off and we are learning to give. And giving while living, that's the theme. So it's just about the early stage of giving. And I hope we do a good job. We learn, we'll have some mistakes in the process. But I think the journey is long. We have already placed 10% of the equity, but that's not the end of it. But even to finish that 10%, I think it is going to be quite a bit of effort. I mean, spending about 6,000 crores. I think it's going to take some time. So there's a lot of work. Investing 6,000 crores is very easy, but giving 6,000 crores is a lot of work.
Well, let's talk about investing 6,000 crores in the new Samvat, Samina.
Indeed. Thank you, gentlemen. And of course, good on you, Mr. Agrawal. You're leading from the front. We all have so much to learn from you in more ways than one. Investing aside, giving, like they say, jigar chahiye, right? Yeah. It's one thing to talk about it, the other to do it. Mr. Chokhani, I'll start with you and the report that you shared with us. And lots of points stood out, but I'll take it from the top. You talk about how India, which we all would agree with you, is in a once-in-a-generation sweet spot. What I want to understand from you is how sustainable is this position amidst the global economic shifts that we are currently witnessing, and what reforms, initiatives you think are critical at this juncture to ensure that the momentum for India continues over the next decade?
Wow, that's a very big question. But let me give the first shot, and Raamdev ji is 10 years older than me, so he'll have a wider perspective. But let me take the first shot. So number one is, look, our economy has grown for the last, 30, 35 years since we started on the reform path. And we're doing easily 11, 12% nominal GDP growth. And as we have shifted from the informal to the formal economy, the formal side of the economy has been growing faster. And the more competitive companies, which are then becoming a larger proportion of those markets. And across categories, you find that the top 5 companies tend to take 75% of the profit of each sector. And there are so many sectors in India, like when the US was growing, that you don't have a dearth of investing opportunities. There's also no reason to believe that we won't keep compounding at this pace. And at some point, the inflection point comes because of both demographics as well as greater use of digitization and technology, where you might hope to even accelerate this growth. So like I always try to say that we've reached whatever $4 trillion today. When I started, we were probably at $250 or $300 billion of GDP. So it's already been a long 30, 35-year period. And the next 20 years, clearly, 90% of our growth still lies ahead of us. So each time as an investor, when you take a short-term view on things, you end up shortchanging yourself in the long run, which is not to say that markets are not pricey and they are not ahead of themselves, and markets will never go in a straight line. But like they always say, follow the master, not the dog. The master in this case being earnings. And as long as earnings hold up in double digits and closer to 15%, markets will tend to follow. From time to time, we overshoot. From time to time, we undershoot. But on balance, you will end up making that sort of return from our market, which again implies at least a 10 times expansion of our market cap from here in the next 20 years. I'm hoping it's even more, but I would take a bet that we would be 10 times higher. Turning quickly to reforms, it's again, this government's done a series of great things, and it's probably the harder stuff which now has to happen. They're doing stuff like import substitution, PLI schemes, the infrastructure spend, and so on. But the harder stuff on judicial reforms to speed up this process, to get rid of the regulatory cholesterol in the system, to get a bit more of what I call energy independence, because you can't become a great power without having access to your own energy. And nobody will become a great power relying on third-party technology. So the next 10, 20 years will belong to companies which will, A, create technology, they will create products, and they will own brands. And let me just pause on that, otherwise, it will become a very sort of one-sided conversation.
There's just so much to talk about this, but Mr. Agrawal, can you take on from there? I mean, 10x in 20 years, it could be 12x, it could be 8x as well. But should investors look at the new Samvat as a base formation year for the next few years of wealth creation, or should people focus on it as 12 months of wealth making opportunity?
No, it's always a journey. The wealth creation is a journey, and it is never a short-term game. It's a very long-term game, and if you're in the game, you sometimes become very lucky. So the guys who are actually making money are the guys who had some base at the time of COVID. So like people like Manish, me, or all the old investors, those who were lucky to be actually allocated in the market in February, March of 2020, they only made maximum money because market moved very rapidly in next 1 year. Now, if you start entering the market at that point of time, you can't be that visionary that you'll be able to put your entire net worth into the market between March 20 and March 21. Not possible. So typically the guys who are entrenched, they only make money. See, in equity investing, long term is only 15%. And nobody knows long term is 15% means like 5 years you can expect double, in 10 years you can expect 4 times. But you don't know what is going to be the next 12 months return. It could be minus 15%, it could be plus 25%. So it is as the tenure becomes smaller, shorter, it is almost unpredictable. Now, having said that, so clearly you have to commit yourself for at least for 5 years, longer the better in equity investing. And that's how wealth has been created. That's how we have seen that we have made money in the marketplace. But now the new guys who have come, one of the macro thing is that, why it is so exciting, the journey, and why it is going to be sustainable, is that our savings in last 25 years about 10, 12 trillion dollars total savings if you add up the last 25. In next 25, it will be upwards of 120 to 125 trillion dollars, even if the savings rate remains just about same. If it is little higher as you go and become richer, savings rate could be higher, but still $125 trillion of saving. Last year itself, we saved about $1.3 trillion. So this is going to be a much bigger game. And for the first time, the retail investors are getting into the markets. For 70, 75 years, for one reason or other, they remain outside the market. Now, true equity revolution is happening, where people are coming in and they'll keep coming. Even if market corrects a little bit, it is going to make the market resilient and the game will become bigger. But the people who will make money are the guys who will actually take the downside of flat market on their stride and stay put for the next upward march. And that's where you're going to make money. So I would suggest you stay invested till you make money, because this market will make money for you.
Right. Manish, you want to comment on that one? Because significant wealth has been created in a decade that you and Mr. Agrawal, in some ways, discovered equities as an asset class, right? From where we stand right now, sure, the last 4 years have been glorious. Retail investors have made hand over fist. A lot of it could be transitional in nature because I think the behavioral aspect of a 30-year-old or a 25-year-old is very different from a mature investor. Looking ahead, do you feel the road ahead could be as glorious as the road behind?
Samir, are you asking obviously about the current year and
I am, and looking ahead, right? Because it's tough. It's tough to stay invested when times aren't going in your favor.
No, it's right, but like Raamdeo has been saying for a while, and as have I, that valuations in India are not cheap by any measure, and the best kind of 24% and 40% CAGRs we've seen in the index or in the mid cap, small cap index is not going to repeat because the underlying earning growth is low teens currently, if that. And the market needs to digest the gains it's made. And the normal capitalist response to this kind of demand, if Indians are putting in almost $50 billion a year now into equities, which is still kind of 5% of the annual saving rate, not even that, the supply has started meeting that demand. If I just take the last 6 months, there's been about $30 billion of fresh issuance, of which only 15 has gone back to companies for creating fresh capacity. $15 billion has gone back to promoters who have sold or to the private equity investors who had got early into these companies. So some amount of it, of course, will come back to the markets. But for instance, you had the Hyundai listing. It's a net $3 billion outflow from India back to the strategic investor over there. And this trend has been seen across. People from US like GE, Whirlpool have sold. From UK, Vodafone and BAT has sold. From Japan, Sumitomo has sold. From Singapore, it's been Singtel, which has sold. And even Indian promoters, whether it's Tata Sons, whether it is Vedanta, they have all come and taken chips off the table. Hopefully, they will come and reinvest because, like it happened with the first flush of private equity investing, when Warburg Pincus made $1 billion exit from Bharti, it opened the floodgates to private equity to India. And therefore, I'm quite hopeful that a lot of these foreigners who have tasted that India can provide you these kind of returns and this kind of money will only serve to attract a lot more FDI and a lot more foreign investors in. Because remember, we are barely 3-4% of global market cap. And as a country which is going to rise up inevitably, what the markets do are one side. But as you grow up the GDP ranks from 4 trillion to 10 trillion, it's inevitable that people will have to come and invest for growth over here. Because whether it's US, Europe, Japan, UK, they are all ex-growth. And even China is currently, why they're in so much of a mood to settle the border issue with India. When in reality, we have no fight. They're really a Pacific Ocean facing country and we're an Indian Ocean facing country with a very large border called the Himalayas between us. And it becomes a civilization which had partnership and friendship for thousands of years. So hopefully we rediscover all that. But again, it's not about the next 12 months. This will all take its time to occur. All I'm trying to put in context is don't lose faith in equities because businesses do compound average 15% every year. And as long as you stay in for the long haul, you should tend to make that sort of return. And your differential, remember, is fixed income, where you're not even making half of that. So I don't sometimes understand why Indians either want to make 7% or they straight want to make 25%, and there's nothing in between. Whereas the power of 15% compounded for 10 years is 4 times. And occasionally you will get lucky. I mean, I just mentioned quickly in passing, last Diwali, I remember Raamdeo and I on the show, I looked at Raamdeo and said, Motilal Oswal will be 10 times in 10 years. And he looked at me and smiled because he's already up 5 times in the last year. And I hope he continues that trajectory so he can give even more. And it's stuff like that which happens when you're sitting on something which is well run, well governed, and looking after client, you tend to make that kind of money.
I think he was bemused that you were underestimating the compounding power of the Motilal Oswal franchise, maybe.
Well, we'll talk about your business because that's also very exciting, Mr. Agrawal. But before I go into that, you talked about staying invested for the long term, and we all talk about this power of compounding. But the fact remains, if you are a retail investor who's building a portfolio, you do get carried away by new ideas, and everyone talks about the green energy, let's talk about renewable. It's all very exciting conversations to have. But how do you find the next Reliance? How do you find the next Tata? How do you find the next TCS and Infosys? What should one be looking for? And how should one go about looking for this?
Yeah, so for masses to find, pick up stock ideas, it will be tough. Even for us, it is very tough. But even for the masses, it will be really tough. We grew up in an environment when there was no mutual fund system and you had to buy stocks directly, and hence we trained ourselves to pick stocks and things like that. It can be done in much better way even now. But the good thing is the people who are very busy, they have a banking job, their insurance job, or their doctors or whatever. They don't have time to read books or skill themselves in stock picking. It's a very competitive environment. It's actually the professionals are finding it tough to pick stocks. So what to say about amateurs? So what I would say is that if you are seriously interested in investing, India is going right way. They are doing systematic investment plans in big way as a nation, and you should join that force. But if you want to build a career as a stock picker, then it's a very treacherous and tough job, and you got to become analyst and you have to learn the ropes, read the books, read the blogs, read the balance sheets, commit enough mistakes, and obviously then you'll be a master.
Mr. Agrawal, the recency bias of how you look at data tells that there is an impending slowdown or probably underway. Recognition of the same is happening. Will it spill over into the current Samvat? Now we're talking about the next 12 months. Will it spill over into the first half of the current Samvat, and could that have a negative impact on the markets, or is this also a dip that will get bought into the way the last 3-4 years have seen?
Yeah, so I think if you see today's newspaper, even RBI governor is quite acknowledged this particular fact, and he has said that in second half things will recover because you can't get a research what RBI can get, and if he's saying that the first half is impacted, particularly second quarter is impacted by intense rains and things like that. So, and I think it was impacted by the slowdown in the government expenditure also because of the elections and things like that. So now in second half, I think with the full fury, government expenditure will happen, and even private capex and consumption, they should all come back. So that's the hope. But in economy, it's a larger picture. It is very tough to. I'm not equipped to say how economy will behave, but slowdown is clearly visible, and that will be reflected in the earnings, which is going to be about 6-7% up as per our research department's estimates.
Okay. Manish, the other aspect would be that the way to play themes, because the erstwhile regime of, I mean, until 2020 it was buy at any price, and that got rewarded because growth at any price was getting rewarded. We suddenly hit a period wherein there was a mix and a flux happening between both of these. Is there a change in regime currently? Because the last 1 month, we've seen companies which were priced to perfection on the narrative getting punished viciously when the first sight of numbers not up to the mark started coming in. Is there a change in regime, or is this temporary? As we hit the new Samvat, I think that will be very important.
Okay, let me take a slightly step back. So first, as you said, the average investor in India is now under 40. 69% are under 40, but majority are under 32. The real route to wealth is for all these guys to go and build businesses, not just make money in the market, and certainly not be doing FNO and SME exchange and all. So if you have one takeaway, for years I've been saying, go and build a business. 90% of India's GDP lies ahead of you in the next 20 years. That is the source of wealth creation when you have large chunks holdings in companies which do well. If you can't do that, whatever you're doing in your life, in your career, don't then waste time trying to pick stocks unless you want to devote time to it full time. Be happy with the average market return. And I hate to say this to the wealth management industry, people only need 2 index funds in their portfolio, one Nifty fund and one small or mid cap fund, and one fixed income fund, good enough. That's part one. Part two of where you're heading from here, if you indeed want to look ahead at different themes and different formats and so on, again, you can do thematic funds, but it should be in a proper mix and asset allocation. So again, just basic lessons. Let's get our asset allocation right, which may be, if you're 30 years old, 70% can be equity, 30% will be, some sort of fixed income for stability and for giving you cash in periods of drawdowns like we're likely to see. Secondly, within that, you do your large cap, small cap type of mix, which again gives you resilience in times of difficulty because people haven't seen a drawdown in the last 8 years. Number three is your position sizing because we made so much money on small and mid caps. When you look back, you realize, hey, this stock, which was a 5% holding, has become 20% of the portfolio. And that should be right sized as well. So once you've got all that in place, only then we should then start having the next discussion about resetting your expectations, because what's happened in the last 4 years is not going to repeat this year. If we make double-digit return in this coming Sanvat, I think we should be happy. Tread some water for a while, let the earnings catch up. And this regime change, remember, markets go through cycles. What were the leaders of this bull market? If you take it from 2020, 21, they were the people who blew up in 2008. Capital goods, real estate, PSUs. They went to sleep for 14 years and then they came back with a vengeance. And the stocks which did well, like you say, buy quality or great businesses at any price, which was in the erstwhile era, you would talk of, the Nestle's and the Page Industries at one end and the HDFC banks, Kotak's, Bajaj Finance at the other end. They became the laggards because by now it was cap goods, PSUs and others which were running. And it was the banks which had not performed in the last cycle, which were PSU banks and ICICI Bank, which went from being a laggard to the leader bank. And as that cycle now plays back and people realize earnings have caught up, they've gone back to the defensive businesses, which are IT, pharma, FMCG. The valuations are not necessarily defensive, but that's where they've gone to hide. But I suspect why you're now seeing this renewed vigor coming back to the HDFCs and Bajajs and all of the world is that cycle starts turning again. And this is like I said, a market which goes through its various waves. As long as you stick to what you know and you play through the cycle, you are going to make the earnings of the company. And if you started on a low base of multiples, your asymmetrical bet, what I love saying, that you buy a rupee of earnings for 50 cents. What was happening in the last 3 years, I was being advised by youngsters that, uncle, as long as the earning is growing 150%, how does it matter if you're buying a 100p stock? And it's when that 150p faces a earnings which is not 100, even if it is 75, that's when you see 20% stock declines and there's no buyer on the other side. So those lessons only time can teach you. I don't think, we can sit and pontificate as much as we want here, but it's very exciting when stocks are going up 400% in a year and you think this old guy was telling you all kinds of, defensive asymmetrical investing is kind of passé. And that explains why Warren Buffett's longevity has been there, right? The man is sitting on $270 billion of cash. It tells you what his worldview is.
Yeah,
Let me pause.
I would have loved to be the fly on the wall when the person or the kid or a set of kids were told Manish ke uncle, आपको investing नहीं आता है, हम बताते हैं कैसे होता है.
New age. But Mr. Agrawal, what do you think are the sectors or themes that could be significant wealth creators over the next 10, 15 years? I'm very tempted to ask you for the next 1 year, but I know that would be completely wrong.
Yeah, so, see, in the market, say there are 50, 55 groups or industries representing most of the stocks. Now here, what happens is that, good thing is that all 55 are never in bull run, or there is no tailwind in all 55. There are few segments of the economy have the tailwind. And if you can pick up the stocks at the beginning of the tailwind, or best is that when there was no tailwind and you are expecting and you buy it when nobody was looking at it. So that's the best. But if you buy very high quality, high ROE, high payout companies without growth, at least in India, it doesn't reward you because those companies are priced to perfection, like 70, 80, 90p or 50, 60p. And when the growth doesn't come, it doesn't make money for you. In fact, there is a chance that you might lose 5, 10% and market might surge by 20, 25%. That's really happening. So we have to figure out which are the businesses where there is a above 10, 12% or 15, 17% growth in the industry. Uh, and that's where some of the segments come, like capital markets. The entire capital market, thanks to retail boom, which is happening for last 2 3 years, the capital markets are on fire, and that's why you see all the constituents, whether it is exchanges, depositories, asset managers, brokers, wealth managers, everybody is kind of growing at anywhere between 25 to even 70 75% types. So that is what is one segment which I can very closely see in my own businesses, because we run 5 6 businesses out of them. So I can see the positive impact on that. So that's one segment where there is a clear bull run. And I think it is a decadal opportunity. Earlier, what used to happen was these things used to happen in the capital market, but they used to be 6 months, one year kind of a phenomenon. And next year it used to slump. But I think here this is, of course, it is not going to go at this pace, but there will be correction, there will be slowdown. But I think the opening of the market and expansion of the market is going to be there for many more years to come, maybe at least a decade. So this is one place where this is asset light. This is one place where I see clear opportunities. Second, I think energy transition. Energy transition is so. I mean, there's a shortage of energy, and on top of it, the conventional energy is giving way to the new renewable energy like wind and power, solar and all. So you see maximum excitement over there, and the companies which are coming in. So those companies are seeing a lot of traction in terms of top line and bottom line. So that's one segment where again those things are coming back to the conventional large. The biggest bucket of profit pool and market cap is the private sector banks. So for last 3 4 years, the whole segment has been kind of a very stuck kind of thing. And now finally, I think we have reached to some kind of situation where the ROA, earnings, and multiples, all three are converging at about 16 17%. I think these franchises are a lot of longevity and the sustainability at around these prices. They look to be very good. So like that, you have to go one by one, and I can see these 3 4 segments. But there are a lot of small segments in the economy which are doing very well.
Investors to leave the heavy lifting to funds like you and your fund managers. But Manish, comment on this. I read a recent interview of yours where you said the best way to play most themes is through financials. And now the definition of financials also is very large. From AMCs to capital market players to housing finance, insurance, PSU, private sector banks. Narrow it down for me, right? Tell me, if I want to play India for the next 5 years and I still want to make money in the next 1 year, while I'll stay investor, I promise, what are the themes and the sectors to bet big on?
So, Samira, this is not a 1 year, 5 year thing. As I'm saying, if you're young and you're 32, you can afford to have a long view.
Now I'm not 32 anymore, Manish.
Well, you look 27.
Trust him to come up with a witty
Yeah,
answer.
that was brilliant. On point.
So if even, I'm sure Raamdeo ji will agree, if we look back, the mistakes we repent are not the stocks we missed buying, it's the stocks which were high quality, which we sold early. Because they've all gone up maybe 5, 10, 20 fold in the period when we thought it's, maybe 1, 2 years ahead of its earnings. So not to say you don't hold stocks which are completely stretched and which have discounted the next 5 or 10 years already in advance. That's one lesson. Number two, you don't make money by betting on the horse, which everyone expects to come first. You bet on a horse which is number 3 or number 4, and that ends up coming first or second because it's the rate of change. And specifically take this financials example, which I just gave you earlier as well, that we all know HDFC Bank is the best bank, but if it was priced for that, you didn't make money in it for at least the last 5 years. Whereas ICICI, which was maybe rated the 3rd or the 4th, it revved up, it's upped its game, and it's now become the sector leader in terms of multiples. So you got the earning growth and you got the multiple expansion, and that's really how you ended up making money. Even when you think in terms of 1 year, 5 years, remember, you need to wait for when the bet becomes asymmetrical in your favor. The same discussion I remember we had 2 or 3 Diwalis ago when I was sitting in a minority in a group. I think it was a multi-star 4 people group on TV being interviewed. And we were talking about capital marketplace. And people were giving me strange looks because they say in the West, the world has gone to ETFs and passive funds. How can fund managers in India make money? And it was all about gung-ho being on private sector banks. And today the shoe is exactly on the other foot, that you can't get enough of wealth management companies, brokerages, asset managers, stock exchanges, and what have you. So as Raamdeo rightly says, these are waves, and when you get the bet at an asymmetrical price, that's the fun. If you were to sit back and think next, 5, 10, 15, 20 years, what markets are going to explode? It's very clear consumer discretionary. Everyone, especially coming out of COVID, only accelerated it. That you want a bigger house, you want a better car, you want to go and travel, you want the best hotel, you want the best airline, you want to go and eat out, you want to go, shopping in the best retail place. So consumer discretionary was one obvious place to play. And all these stocks have got stretched to an extreme now. Look at the market caps of, say, a Trent or whatever, what has happened again in the last year. All got stretched. Number two, we thought there'll be platform plays, the likes of Zomato and all, which were 50, 60 rupees, 5 billion market cap, it's 30 billion market cap. But all of these, Nykaa, Zomato, all have played out, brilliantly. Category three, we knew that there will be these privatization plays because government can't finance them and it will fall into private hands. So whether it's Adani at one end or Sunil Mittal at the other end, you've seen enormous wealth creation in these as well. Fourth category, which we all knew is going to be financialization, where the country saves $1 trillion, barely half of it comes to financials. The rest is still going directly to real estate and gold. In financials, as you said, over the period, currently the flavor of the month is mutual funds. When the flavor turns, it goes back to banks. If you remember 2008, everyone was running to put money in deposits in HDFC and SBI. Today, everyone's running to put money in mutual funds. So, these cycles play out and you may get a, opportunity there as well. And the last, of course, is government stimulus on infrastructure, PLI, and so on, to create what is the next wave in India, which will have to be driven by semiconductors, by artificial intelligence, by biotech. And one has to fear for some of our pharma and IT sector companies, these GCCs, because the pace of change in AI and biotech is so fast that in 5 years, what look like sector leaders will start resembling like, these are has-beens of the past. So I think as a full-time investor, it's your job to be on top of these, to keep meeting all these people, but wait for your asymmetrical bet. And in that, you want position sizing. And in that, you want a proper portfolio construction. I think these timeless mantras will never change.
Interesting. My final question, and that is to Raamdeo Agrawal, because in a series that we did in 2017, Mr. Agrawal told me that Neeraj, at times, promoters को खुद नहीं पता है कि क्या होने वाला है. They underestimate the velocity of the earnings growth. So, Mr. Agrawal told to Samina's question that asset managers, capital market plays look very good, but there might be near-term issues. Mr. Agrawal, could it be possible that you are underestimating the velocity of the earnings growth of your own business / capital marketplace?
Yeah, it is quite possible till the.
Sorry. I just thought I should check with you.
Yeah, so actually nobody knows once the tailwind starts, how far it will go. Like this tech boom when it started, 95, 96, India was about $1 billion exports, and actually most of the stocks were available at 10, 15 PE. Infosys actually IPO bombed in 93, 94. And little people know that, after that, what happened in the next 25, 30 years. Today, we are exporting more than $200 billion worth of software. And these companies, which were about 1,000 crores or less than 1,000 crores, have become giants, like 5 lakh, 6 lakh, 7 lakh crore types. So clearly, you don't know, you can see the challenges of this thing, but what this retail revolution will do in the cumulatively in next 10, 50, because these guys are not going to go away. This 180 million will become 300 million, 300 will become 500 million. So this story is going to become big. Now, what happens when it is 300 million customers or 500 million customers, even beyond my, estimate? One thing I can tell you, when we started our career in 87, the daily turnover of Bombay Stock Exchange was just about 200 crores per day. Today it is 400 lakh crores per day. In the sense that we have grown by 2 lakh times in last 30 years, 35 years. So the particularly anything digitized and this kind of increasing savings pool, if the larger portion is coming into the markets, in capital markets, what will happen to the capital market, and secondly, what will happen to the participants? Who is going to win and who's going to win big. And is it there in the price? I'm quite sure it is not there. But who's going to be the winner and where you should bet? Probably you can buy the entire index of the capital market companies rather than picking one or two stocks, because quite possible that your choice might be wrong and somebody else is going to the big winner. So it is good to buy. Nowadays, all kinds of ETFs are available. Capital market players ETF is also be available. Buy them.
Right. Manish, I want to try and get one more quick question in, and also because there's so much of noise now, right? We're all worried about what's happening in China. Hardly do we know what's happening in our own country, but we're concerned about what's going on in China. And I ask you this because, again, we very often hear the very wealthy or family offices talk about the importance of geographical diversification. Obviously, when you're in India, there's a home bias, and we also do understand that at any given time, there's some market that's always doing well. What are your thoughts on geographical diversification? Do you think it's an important pillar for significant wealth creation for the long term for young retail investors?
I think 100%. We are headed to becoming the third largest economy in the world. You cannot have it with a closed capital account. And it's not like Americans put 100% of their money in America. That's why they've become a global superpower. They invest all over the world. And there will be periods inevitably where we will also go through down cycles, whether for overvaluation or whether for cyclical reasons. And you must have money spread across the world. There are different asset classes, there are different geographies which do well, like different sectors and different stocks do well in this market. The same thing applies to the world at large as well. And for a young investor, it should be part of your education now to start learning about companies across the world. When you will see, for example, a Tata Motor or a Maruti valued equivalent to a Honda, a BMW, a Mercedes, it will make you pause to think what's going on. When you see 10 P multiples for Pfizer and Merck and Glaxo globally, and you see 30 multiples for our generic companies here, it will make you pause to think. I do think that this larger educating ourselves and not remaining frogs in the well is a necessary outcome. And turning to China, again, it was a really, really cheap market. I had enough friends from America telling me China deserves to be cheap because it has no terminal value. They have no property rights. Your companies will be taken over. And the very same people are jumping and buying those stocks 20-25% high. So let me pause on that.
In fact, so good to have known that, but India remains the beacon of hope, and that is essentially for the world at large. At the NDTV World Summit, not only PM Modi spoke about that vision, but a clutch of others. So it's great that we've gotten from both of you these insights on Diwali Masters. Couldn't have hoped for anything better. Gentlemen, both of you, thank you so much for taking the time out. And from all of us out here, to you and yours, a very happy Diwali and a prosperous New Year.
Thank you very much, and happy Diwali.
Happy Diwali.
Happy Diwali.
Oh, yeah. And viewers, thanks for tuning in to this very special episode of Market Masters.